Hello and welcome to this special program. We are calling this Stock Market Confessions, the program, the name of the program that is. The idea germinated from a book which is coming out now. It's called Confessions of Stock Market Wizards. The author is lawyer and leading investor Safir Anand. Safir is one of the foremost IP lawyers in India, but also a passionate consummate equity investor. We talk about multi-baggers all the time, winning stories all the time. We certainly love to hear and tell a good story. But usually, the narrator ends up making a lot of money as far as these stories are concerned. What we are trying to do here is not talking about the winners, but the duds. And we will talk about the mistakes which some of the people in this gathering have made today. So with that short preamble, let me actually quickly welcome in our guests on the program today. They really need no introduction. Ramesh Damani is with us. So hi, thank you very much for joining us.
Thank you for having me.
Raamdeo Agrawal is with us. Thank you very much, Raamdeo ji. And of course, Safir is with us as well. Safir, thank you very much. And
thank you for having me.
Thank you for giving us the idea of the book as well. And to help me steer this conversation, I have with me my colleague Reema Tendulkar. Reema, hi.
Hi, Prashant. And it's indeed a great conversation and one that we don't dwell upon very often. But as they say, learning from the mistakes of others is the best way. Well, at least better than making your own mistakes. And we hope that we're able to do that for you just here. And we have with us some great investors joining us in this gathering. So let me welcome Manish Bhandari. We've got Viraj Mehta, Ayush Bhandari, Jyotivardhan Jaipuria, and Punita Kumar Sinha. Well, excited about this conversation.
Absolutely. Should be good. It's a fantastic gathering. Reema, so let's get this started. Let me go across and join our sort of esteemed panelists here. And Safir, let me just start by asking you, what gave you the idea for the book?
See, when we studied commerce and we studied economics and then we saw all these great people and learned from them all throughout, from the Bombay, Rotunda, Roundtable Time, etc., I felt that the only thing that was happening is that we were looking at the successes and there's a reason why they've succeeded. But we have not been able to look at the concept of risk. And they have mastered risk because that's why they've been there for several decades. And I felt that it would have done justice to people to know the side. It's not as people don't make mistakes, but those mistakes don't impact them beyond a certain point. And therefore, the focus of the book was on the learnings that come from when they go wrong and how they attune their minds to get it right.
I think it's a fantastic idea. And the book is already out. It's coming out. It's
Well, the book is out at the Literature Festival on the 31st, but it was open for pre-booking yesterday, and strangely at night, it was all sold out. Yeah.
Absolutely. I think reprints, right? I think already. So it's doing well, and wish you all the best of luck. So we've got a fantastic gathering, as Reema also pointed out, and we've got about 1 hour here, and let's dive straight into it. Mr. Damani, mistakes, right? We're talking about mistakes, regrets, whatever you want to call it, in your long career. What stands out?
You don't have enough time for that. I mean, 1 hour is too short. But jokes apart, we went to a marriage counselor, my wife and me, and the counselor told us, embrace your mistakes. So my wife hugged me. So Safir is not hugging me, luckily, but he's managed to extract some of my failings in the market. And it's really a building block of success. Failure is a building block of success. My old friend Rakesh used to always tell me that we'll all make mistakes, but make mistakes that we can afford. So to just give you some example in my own career, I bought a stock sometime in the mid-90s called MTNL, and that stock went straight from 200 to 0 or 10 or whatever it is right now. So I lost probably my entire capital out there. But I had a lot of other stocks in my portfolio that performed very well out there. So maybe I lost 80% in a particular stock, but other stocks were up 5x, 10x. So growth covered a multitude of sins, if you will. So what I would say is avoid leverage. I never made that mistake, but that's something I always repeat and tell myself, because I learned that from very astute investors. Don't avoid leverage. You don't know how to handle. Most people don't know how to handle leverage. And hold on to your winners, because they will compensate for a lot of losses that you made. So the loss in MTN, while devastating to me, as Safir said, didn't impact me because I had a lot of winners in my portfolio at the same time.
Leverage, your own leverage, and leverage on the companies you invest as well. Both, I mean, maybe.
I mean, probably both, but definitely your own leverage. I mean, it's a very risky. There's some people who know how to handle it, but I would say the majority of your audience or the majority of people in the stock market don't know how to handle it.
Yeah. Mr. Damani, we were chatting earlier, and I think one of the things you told me is really struck with me. You said, and we'll talk about the nitty-gritties, MTNL is an example, and many others will share other examples as well, but when you began and when you sort of started and you came back from the US and when you started the investing journey, you said in a way, we didn't believe enough that, well, we could sort of, that India could change so rapidly and so deeply and in so many ways. And, it'll be rich pickings over the next 20, 25 years or so. So I just wanted to take us through that.
Yeah, Prashant, think about it. I came back to India in the late 80s. India had a balance of payment crisis. A per capita users of phone was like 3 in 100 or some astronomical number like that. And we always make the mistake of assume the past is prorogue. That what happened in the past, that 3% growth will happen in the future also. So we fail to understand that because the Berlin Wall had fallen, we're in the precipice of change. Once things go to zero, they don't go below zero in the market, they'll go higher. And that's typically what happened. All the changes, whether the tax rates came down, whether industrial licensing was scrapped, whether the socialist statist economy went through, all of that happened post-89 because India was in such a horrible shape at that time. And my friends who kind of understood that with a simple underlying philosophy, be bullish in India, prospered hugely from it. I took more time to understand that this is a long-term structural change, that the India that we grew up in was not necessarily the India that was going to be for the next 30, 40 years. And to understand that process took me a long time. But once I understood it, I haven't forgotten about it.
So the learning is what? I mean, stay in the country that you're investing in, stay bullish. And for us, it is India. So you've got to be an optimist.
Yeah, that will also drive looking at the front view mirror, looking at the windshield. Don't look at the rear view mirror while driving because, markets change. Economies are very dynamic. The companies that were in the Forbes 400 25 years ago, even in America, no longer exist today. There are a new bunch of companies. So it was a great mistake to think that you could look back and say that because India didn't work for the last 30 years when I was growing up, it wouldn't work for the next 30.
Oh, that's wonderfully put. Raamdeo ji, mistakes? I mean, what have you, not your biggest, but what has sort of stayed with you, impacted you, and molded you as an investor over the last 40 years?
Yeah. So what happens is when you start from zero, I started in 85, 86, literally with zero capital. So your mistakes, even if it happened earlier, the impact was very small in terms of financial terms. Now when we run thousands of crores, then your mistakes are also in thousands of crores. So then you start remembering them. So more recently, see, I would say, ultimate growth investor kind of, mad growth investor like. So our formula is also QGLP, and now we have made it high quality, high growth. So even one step further. So our belief is that high quality combined with very high growth of 50-60% is not mentally it can't be digested. So markets will always be mispricing, but mispricing to start with, but eventually it misprices on other side also. So what happens is there is always a hype cycle. Any new segment when it starts, so like quick commerce started, before that it was digital companies, before that e-commerce, before that something else. So whenever new growth frontier starts in any economy, there will be massive growth because it will start from zero. Like this one, Bharti Airtel came in 2003, when mobile phone came, the month-on-month growth was 8-9%. So that was a kind of scorching growth. And that's where kind of we used to take plunge in. But there is a hype cycle. So what happens is stocks or earnings grow or top line grows at about say 100% per annum. But the stocks will grow 200-300%. So the hype. So you ride the hype cycle, and right at the top it becomes so compelling. I can sell the story to even person like him or anybody. And you sell. While selling the story, you are obsessed and you allocate. And that's where the maximum allocation comes right at the top of the hype cycle. And everywhere you are right, but you are right only for 6 months. The hype cycle will collapse in less than 6. This is called Gartner's hype cycle. You can go and see. We have written in one of the papers. But so any hypes, but then you incur massive loss because the drop is almost 50-60%. So you invested say 1,000 crores, straight you will get to see 500 crores loss. So I mean I've incurred once, okay, and I've seen earlier also, but now the losses are bigger because of my investment size is bigger.
And specifically, since you brought up the quick commerce, you're talking about quick commerce in the current
yes.
phase. It'll be easier for people to understand where you're coming from in that sense.
Yeah, so when Swiggy came 3-4 years back, 3 or 4 years back at the COVID time, that time when Zomato was getting listed and Swiggy was unlisted. So at that time, there was a possibility to buy private placements, and Zomato itself was at a high, and Swiggy was comparatively comparative, say, Zomato was trading at 15 billion, this was trading at $10 billion.
$10 billion.
We went and put it there. And I was about to put money, I was asked to put money in Baizu also. Can you believe what would have happened? So that is the hype cycle of e-commerce, because they're growing at 100%, 200%. So that's what really happens.
But that has not been a mistake.
No, see, but then it collapsed, no? Zomato, if I was in Zomato, say 150, 160, that came down to say $45. So, okay, fine. From 45, it is again 300.
So your point is to not to allocate at the top of that
you got to
frenzied
be, see,
kind of
when you are
cycle.
investing, I'm not talking about speculation. When you are investing, you have to be very clear that are you riding a hype cycle?
Yeah.
See, you could be in for 50% correction and then again ride back, but you could be in for 90% correction also or 100% correction. Then what do you do?
Absolutely.
So, particularly in growth, because as the economy becomes bigger, newer segments, whether it is a quick commerce today, tomorrow something related with the AI, and then something else, the system, these digital systems are accelerating the growth. So growth hype cycles will become even more louder, all over. So if you get stuck at the top of the cycle, my sense is you'll end up committing more often mistake than good investment.
Absolutely. And to be clear, you're not calling quick commerce, you're not turning your view on quick commerce. You've been a big believer.
We already made money, no? From what mistake I committed, that mistake automatically got corrected.
And you remain.
But you imagine what would have happened if I had invested in second one also.
Absolutely.
I actually, that time only we wrote the paper and I saw the Gartner hype cycle and yet I invested. I was so obsessed about that.
No, I think it's a fantastic point, and we will get newer and newer industries, newer and newer sort of cutting edge, and so much is happening, and it'll all come here. Let's go across to Samir, who's joining us from Singapore. Samir, you're the only person not here, but you can hear us, I hope, clearly. And you're someone who's a first principles thinker. You kind of sort of bring originality to the conversations that we have. In your long career, Samir, what would you say has been your biggest mistake and then learning?
First, I would like Raamdeo to clarify that he's not calling quick commerce a hype right now. Otherwise, that will be your headline and everything else will be lost.
He's already clarified.
Okay. So I've also made the MTNL. By the way, I moved to India in 93, and in 93 December, we launched our offshore fund. And the first stock, therefore, in my life that I have bought professionally was MTNL at 310 rupees.
Oh, wow.
But separately, in this life, I have made each and every mistake that can be made, which include buying leverage stocks, which can mean remain bullish for too long. It can be like in 2008, it can be buying companies where you forgot too much to bother about balance sheet, looked only at the P&L. We bought Amitabh Bachchan Corporation, which went to zero. Buying unlisted stocks, that is my main example or the only example of buying an unlisted stock in the fund. And so all mistakes have been made, but the one which I have...
Samir, we lost your audio there. We can see you clearly.
Oh, is it?
Yeah, you're back. Please, go on.
Okay. So in the book, I spoke to Safir more about what happened in 2008. I was in my alliance days and in the first 2-3 years of Helios called Mr. Bull, like Rakesh, and I used to collect bulls and I have bull paintings and bulls and all that. And then in 2008, I became the defender of India on TV and in interviews saying India, nothing is wrong because Lehman Brothers and these MBS and all is not India's thing. ICICI has not lost any money and HDFC Bank doesn't need to raise capital. And we have met the company and it is growing 30% per annum, which was the case of HDFC Bank that year. And the stock fell 52% in rupees. And I realized this is because I took this mantle upon myself that I have to defend India, or I have to defend my stock market, or I have to remain bullish. And since then, I have become more cynical in general and also connect more to global, this thing and macro and all that, which right now is again making me do a small mistake because I think the world is good. Therefore, India should be good also. And it's the other way around right now. But in general, that changed me a little bit and I no longer defend anything to anybody. I say what I feel and I collect bears. I even bought a bear. Normally, bulls you buy, you're okay. Bears you normally get as gifts, but now I'm even willing to buy expensive bears. from Dom and others. But basically, over a life cycle, you more or less make every mistake that you can. The only mistake I have not made, which is why I remain cheerful, is that I never concentrate on any one stock in terms of weightage.
Right.
So normally the high weight will be 4-5%, so you lose 20%. You can recover it, or even if you don't recover it broadly, it gets lost in this thing. The process has to give the returns, not any one stock, and therefore I'm not beholden to anybody. I don't care for any promoter because according to me, no one guy made me my returns.
Right. And your experience in 2008, Samir, made you appreciate, because I see you very firmly believing that what has happened around the world, what's happened in the US in terms of trends, I mean, it'll happen here. I mean, something extraordinary or very different cannot happen. So you're more appreciative there? Yeah, sorry, go on.
So that's what I was saying. The point was that, normally we can say our company fundamentals are different and that is different. But if the world is in a crisis or in a bad shape, then everybody becomes a financial investor, and that becomes the connection between different markets, that there are financial common investors, or even if you're not a common investor, you can look at the other market and feel bad. Therefore, I never, prayed for China collapse and things like that, which people were praying, 2-3 years ago or 2 years ago, that if it collapses, we may outperform, but we can't make money. Right now, it's going a little bit off because I think the world is good, everything is good, but somehow India doesn't seem to be performing. But that I will still go with this global macro, that if the world is positive and strongly positive, we can underperform, and sometimes we should, but we don't have to be negative.
Absolutely.
In returns of the market.
Well, let's get in, Punita, in the conversation. Since we're all reminiscing of the 1980s, 1990s, you were one of the earliest FI investors in India. And what, to your mind, is the biggest regret over your investing career?
So, thanks, Reema. Thanks, Prashant. So, you're right. I have to date myself. I did start around the same time as Samir.
Well, you need to take the mic.
Is it on?
Yeah, it's on, please.
So, I did start around the same time as Samir. In fact, we were classmates at Wharton, and then we soon started our careers the same time in fund management. So I started investing in India when India opened up for foreign investment. I was investing in other emerging markets before. And so there was no real interest in India per se, because Malaysia, Southeast Asia, those markets were far bigger and more interesting. And India was like, okay, it's just newly kind of liberalized. And we would have, I remember my first meeting was, Lalita Gupte coming with an ICICI convertible or some kind of debt instrument, and we were like, okay, India's finally starting. My biggest mistake was when people came and sold us the India story. I remember Ratan Tata coming to our office and showing us penetrations of motor cars in India and how low it was compared to global. And the numbers were like so low compared to what you saw in the US. And he tried to persuade, saying, well, look where we can go and how far we have to go, and we will get there. And we were a bit skeptical, having grown up in India pre-liberalization. How can it really happen? And so whether it was Mr. Aditya Birla who came to our offices, all these luminaries would come and sell us the India story and how much potential India had. My biggest regret is actually not believing them fully and not betting as big on the opportunity as it existed, because one never really believed India would actually deliver. Of course, it is now 30 years later. So it has taken almost like 25 to 30 years to fulfill that promise on the opportunity. Now our penetration, whether it's cellular, it's exceeding many other countries, and India has wiped out Southeast Asia. The markets there are so much smaller. But that didn't seem that it was possible. So I would say that I was a bit too conservative, having been one of the first investors in India. I had maybe too much skepticism. And sitting in the US, it becomes easy to be skeptical because you look at US and where it was, and you can't ever imagine India could get there. So I think whether it's the stock market, look, when I started, the market cap, believe it or not, it was only $110 billion. And look at where the market cap is today. Would I have believed that when someone told me 30 years ago that this is what India's market cap would be? Not at all. So the regret really is that not fully betting everything on India.
You know, we'll have to take a quick commercial break here. I'm being told we need to, so we'll do that. We'll come back and we'll really get down to specific situations, specific stocks, and we'll bring in, of course, our other guests as well who are here to share their insights, their anecdotes with us. Stay tuned, coming right back.
Welcome back to our special show, Stock Market Confessions. We have with us the wizards of Dalal Street here right now, and they're going to share the mistakes that they've made, which has shaped them into the investors they are today. So, Manish, let me come to you. Manish Bhandari is the founder and portfolio manager at Helios Capital. Manish, looking back, what would be the investment decision that you've made which you regret the most?
In 2 decades of public investing career, I had many mistakes. And maybe I'll resonate few of them. The first one is to think that you'll go right on every investment decision, which should not be the case. You'll always win some and you'll always lose some. So it takes a long time to really believe that you'll have some outcomes. As long as the bigger probabilities are in your favor, that's good. So that's one mistake which took a long time to really realize. And you pain yourself much when you think there are some few stocks which have lost. Second thing is, one of my biggest mistake has been taking some time to understand the really concept of time value correction. And I got invested in a pharmaceutical sectors way back in 2015, and which was in a resounding bubble at that point of time. And it took 7 or 8 years for those prices to come back again. And there was a huge loss of value which goes through down, as well as the time value correction. And it's painful because in nominal terms, you lose maybe close to 70 to 80% as those bubbles goes bust and comes back again, maybe the real price. And the last one, which is a bit noticeable, was that how to look at the divergence of the data and from the management commentaries. And we all get sold by those glorified managers. And I get invested into a rice leader company. And for a long period of time, there was a divergence in the data as well as the management commentary. And I was not able to capture that. And I was maybe looking at the glorified commentary for some bit of time. And that taught me a very valuable lesson that data is something you have to believe, and you have to hold it very carefully and then just exit if the data is not in your favor, irrespective of the management commentaries.
But Manish, the data could be backward-looking, while the management commentary could be forward-looking. So in that sense, what's the lesson that you've learned? Because you could be missing out on an opportunity.
No, the divergence. Some point of time, see what has changed. If you look at the sources of alpha, initially when I came to the market in 1999, the investment bankers or the access to management was a very superior source of alpha. Maybe after some period of time, as the democratization of the information happened, the data flown in on the analyst or on the fund managers is significantly higher for you to make maybe 2 + 2 and finally figure out that what is going right and what is not going right in your direction. So it has changed a lot in this process. So definitely there'll be some point and data points which will really give you an indication that the things are not going as you are anticipating, and that will be a time. So those divergence can be figured out through some careful analysis, not in all the cases, but in many of the cases.
Okay,
In
so
this
data.
case, there was a corporate governance
There was a corporate governance issue, and then they lost a big customer in one of the key GCC markets, and then we were very hopeful that those markets will come back again, and this commentary was always positive and always a step ahead with each quarter, but it didn't happen. It took a long period of time.
And the pharma example that you gave, Manish,
yes,
that was purely earnings? I mean, which kind of...
So as Raamdeo ji was alluding to, so in a peak of the bubble, you'll always have the earnings which are galloping, and along with the earnings, the P multiple also expands, and which would have happened in the case of defense companies at this point of time. So you have a huge cycle, tailwind of the earning cycle, and that certainly a 20p multiple or 20p multiple sector would finally become a 40p multiple sector. And when you fall off the cliff, there's a contraction in a P multiple, as well as there is a slowdown in the earnings. So there is a nominal destruction of there is a real destruction of capital, and it'll take long for those capitalists to come back again. So you really, maybe it's a challenge that how do you figure out that when is the cycle going to end? And for that, the best thing is to look at the earning cycle analysis. Any company, if you bought any part of the world, if you're buying something at the bottom of the cycle, you can't go wrong. Many of the cases, unless until you have a case like a pager and a Nokia or something else which is going out from a technology perspective. Otherwise, you won't go wrong in most of the cases. So
Absolutely.
earning cycle becomes a very important aspect while you're doing the investing.
You know, Punita, you were also, we were talking earlier, and you were talking, sharing some, your own sort of governance kind of pitfalls, right? Why don't you share those with us?
Yeah, hi. So, now I'm on lots of boards and I realize how little we tell investors or how little investors know what's going on in the company, because there's so much more to a company than what is communicated to investors. And,
Need to know basis.
Yeah, mostly the investors are communicated mostly earnings results, right? There's not a lot of discussion on what's happening behind the scenes to get to those earnings, what struggles, what attrition levels we are seeing, what's happening in the culture of the organization. There's so much more that goes on that we don't, as investors, see. And I remember the times, and even now, one is prone to that, is that now, of course, SEBI has come up and Companies Act has come up with all these disclosures on related party transactions, and there's a lot more social media. So you get to know a lot more about a promoter because the data is better and the information dissemination about somebody is better. But way back then, I remember we, at least as foreign investors, we, of course, those who came to visit us in the US would get more attention. And I'm sure in India, those who were meeting investors more regularly ended up getting more money. So, and the storytelling, the ability to tell a story. So those who told us a good story were the ones that one would kind of tend to, believe in. And I've had occasions like this. So I'll give you two examples: Global Telesystems, Himachal Futuristics. Of course, I've also got trapped in MTNL, the value trap.
You all did.
MTNL seems to be like
Mera telephone nahi lagta. That's what he called it.
Got trapped in ABCL,
What is that?
Amitabh
Mera
Bachchan
telephone
Foundation
nahi
as well.
Oh, I see. Okay.
But so there are these value traps, especially PSUs were like super big value traps.
Were.
Yeah, not anymore, but anyway, so these two companies, I remember I had this American analyst who came down from the US and he met with one of these promoters. I won't name which one of the two, but he went, they wined and dined him. They took him to see all their charitable endeavors. He was a very spiritual, religious kind of guy. So he came back and he said, not only the opportunity great, this man is super generous, he's so humane, he has all these charitable endeavors, he cannot do anything wrong. And so often you go by what the character is projected to you versus what the character might be, and what the numbers that are projected or shown to you versus whether they're inflated. We saw in Satyam, the numbers were being inflated, but Ramaligan Raju was a very nice man. So when you meet him, you could never imagine he would be like doing all of this. So what meets the eye isn't what's true. And so over the years, you can get trapped. And I've got trapped in Himachal and Global Tele. And when the hype cycle is in your favor, you made a lot of money. But when the .com bust happened, these things crashed like anything and you couldn't get out. There was no liquidity. And so you just saw a stock going from 1,500 rupees down to like, I think, few hundred rupees, and you couldn't get out. It's a falling knife. So you have to be very careful when you invest in all these small and mid-cap companies, not to get carried away. Actually, the closer you get to a promoter, the more mistake you're going to make, because you're going to hear what they want you to hear. So actually, to be a good investor, you should keep a distance so that you can be objective. And I was giving this example of my analyst who, the closer he got to this promoter, the more he saw the goodness and the good work. But who knows? I mean, people still do wrong things. They can do good work and bad work at the same time. And you don't get to see that. So best to focus on the numbers, best to get diligence, best to get investigative journalism, all of that, and focus on the governance aspect as well, the board, and not just... but of course, CEOs can also fake the board. So, you have to be very careful. You can get trapped. And so you always have to have a margin of safety and a healthy dose of skepticism.
Okay. Ayush, you've got an example to share where you invested in a stock and there were rumors of corporate governance issues. So how did you deal with that?
Hi, everyone. So I'm more of a very small mid-cap, micro-cap investor. And when it comes to those small companies, I think mostly you will find some issue or the other. And as an investor, you need to also learn how to ignore some of those things. You need to learn what is ignorable and what is not. So this is almost 7-8 years back during the previous bull market. There was this textile company I was crazy bullish on. I got in very, very early on it. It was hardly a 200-300 crore market cap company at that time, and they started doing very well. They had some excellent billion-dollar customers, US customers. You go to their facility, it's top-notch, excellent, world-class facility. So,
Ayush, we talking about Kitex?
yeah.
Sorry,
And it went all the way up. Like it got the market attention. It went all the way up, almost maybe from 300 crore market cap to almost 5,000 crore market cap. So that is the kind of delivery the company did, management did, all world-class. At the same time, there were always some concerns, red flags, which were always highlighted. But when you are a believer in something like someone shared, you are gung-ho on it. Like, I have seen the management, I've seen the facility, and you're all in it. And that's where, like Manish said, you need to learn how to spot where the numbers go missing. So when the performance falters, you need to wake up. You need to take note of it and not get carried away with all the story building, all the forward-looking things. So that is, I think, what is important and what was a lesson for me, that once, especially this happens more when things are very expensive. Like once things are small, they are cheap. At that time, the risk of going wrong is much lesser unless the company is a total fraud. Some softer aspects are ignorable. But once things really grow, they become big, then one has to be much more critical of the governance part. That is what I feel.
What happened in that instance, though? I mean, were you able to get out?
No, I was too late. I was totally committed. Like Samir said, I was defending all the way that, no, my company is right, this is right, this will happen. But, and it went all the way down by 70-odd%, 80-odd%.
Kept buying along the way.
On the way. So earlier I was making a lot of money. Then due to averaging, my cost went up and I was at a loss. And that wasted maybe 4-5 years. But again, see today, the company is back. It is doing very well. So there are cycles in the market. Like Manish was saying, that rice company may be doing back very well again. But at certain times, you need to be very careful and not make those mistakes of staying into something which is too expensive, which is in that hype, like Raamdeo was saying. So you need to take some action or the other and not just be blind to it.
Absolutely. Viraj, come in. Viraj, of course, is a star investor, needs no introduction. In your experience, Viraj, you want to take us through an instance and through the prism of that one episode, what came through?
No, thank you so much for having me here. I think I'm probably the youngest investor here. I started investing just 15 years back, so I have at least no baggage. I only hear what happened in 2008 or what happened in .com bubble, but I've not lived through it, and COVID was too small to actually regret too many things. I think my regret essentially is just, I think the biggest mistake I've done is underestimating a promoter who overestimates himself. I think a lot of guys in India are growth hungry and they do a fabulous job of it. And I just lose patience very, very quickly. Like, I buy a stock and I lose patience in like mentally I made up my mind that I'll give this company 6 quarters. And after 6 quarters, like, you give 1-2 more quarters, but like, if the business cycle is just not in their favor, it's not in their favor. And you lose patience and you sell out just before it's going to like do really well. Even though the company is like fabulous, at least you have done your part. You bought it very cheap. You bought it at like 1/3 sale, 10 times P or 8 times P, 25% ROE, great business. So everything you have done, but the growth is not coming and market is punishing for no growth. No growth gets no value essentially. And then you lose patience and then the growth comes. So my only learning is, if you have done that, I mean, cheapness plus growth is magic. Just wait for that magic to happen. And more importantly, when that magic happens, even if you have sold it earlier, don't get biased. Like we talked about Technocraft, right? It was a fantastic company. I bought at 500 crore market cap, and it went down to like 300 crores and growth wasn't coming, and I sold it. When the growth came back a year later after I sold it, I was just too biased. कि नहीं ये तो एक ही साल ग्रोथ आएगा फिर वापस ग्रोथ नहीं आएगा क्योंकि पहले 5 साल नहीं आया, and then growth just keeps coming, and that hurts you so much because today it is 5,000 crore market cap, but the problem is it is in your watch list. You see the quarterly results every quarter, you attend the con call every quarter, and you feel so dejected. In my fund, I owned 2.5% of that company. I'm like, that would have been worth 150 crores and probably going to 500 crores. So yeah, I mean, when I actually have absolute capital loss and I lose 25%, that day it hurts. In the evening you feel sad, but next day I forget. Like that at least I'm okay with. But this hurts me far more.
So the notional loss of a missed opportunity is what?
Yeah, and not able to get back in.
Not able.
That's very well put. Very, very well put. Let's bring in Jyoti as well, who's a long-time equity analyst. You were on the sell side, Jyoti. And I discovered personally very late that you are such a fantastic micro and small cap investor. I mean, all your life you were talking about, at Merrill you were, and you were talking about FII flows and the big stuff. But you really got the head for, bottom-up stock picking. Tell us...
in your form of a PMS just now.
Tell us, Jyoti, what have been your sort of learnings, and give us one or two instances.
Yeah, so, everybody discussed stocks which went down, right? And each of us, I think if we start listing down, probably each of us can write a book on how many mistakes we made. But 2-3 themes which are, this time is different is the most, difficult phrase I find. Every time it's never different, but at that time it seems different. It's like you take the 2000 era, the market was paying companies for, clicks on their website. So there are companies who are sitting and employing people, just keep going, click it on my website, do nothing else, just keep clicking. And the market value is going up. In 2008, we paid for land bank. And so, people were just buying land left, right, and center that, okay, I buy a land for 1 crore, my market cap tomorrow goes up by 8 crores. So, a lot of times market does something which, incentivizes promoters to do misallocation of capital because, they just feel today my market cap is going up, I'll do this. So, but let me shift because I'm the last speaker on the first round. A lot of times we always talk of mistakes as stocks which went down. There are many other mistakes we made. So one is, we bought a stock which went up a lot, but we didn't weight it enough. So we bought a very small fraction, so it feels very good that I did a 8-bagger on this. But you know what, I had only 1% of my portfolio in it. So why I had only 1% when the portfolio was... So we've had it with a couple of stocks in our fund also. One of the media stocks was up 8 times in 2 years, but we had only 1% in the portfolio, so it didn't really help us. Sometimes, we buy a stock early, we end up selling it too early. So, just in my old era, we covered Eicher Motors at a market cap of 1,000 crores, and we put a buy on it. And frankly, at that time, all of us put buys on Eicher Motors, not because of the lifestyle motors bike business, but we put it because there's a Volvo joint venture which was coming up. And, as the Volvo joint venture took up, the stock went up. But, that whole bike business was becoming bigger and bigger. But everybody was anchored to, this bike business it's a niche business. It will do well, but beyond a point, there's no growth in it because the addressable market is very small. And so for a lot of us also, we put 1,000 crores. I thought we got cautious somewhere at a 10,000 crore market cap. And today it's 1,40,000 crore market cap. So very often the mistakes are you sell stocks too early. You get negative on them too early because, there's an early bias. You've seen like a multi-bagger. You don't want to lose the money which you made, or you don't weight it enough and, then you regret it that why didn't I weight it enough? So probably some different angles of mistakes which are not... which everybody's been talking about.
Jyoti, I must say, if the worst confession you have to make is that you made only a 10x return and not a 100x return, it's not such a bad problem.
No, I said there are lots of stocks where went down, but I don't want to talk about them. It's too long ago.
Exiting prematurely is one of your regrets or lessons, right? And if you're going in, then go big.
Go big and go to some size. Samir is not a great fan of concentration, but we probably are more concentrated than he is. Right. So we own 20, 25 stocks in the portfolio. So for us, generally now what we have done is, as a rule, we don't do anything less than 3% in the portfolio. So our minimum weight is 3%.
All right, here's what we're going to do. We're going to slip into a very short break. But on the other side, we'll continue our journey. So even the most seasoned investors do make a lot of mistakes, and we'll chronicle their journey.
Welcome back. Well, this is a show which is curating mistakes were made by stock market veterans, and we've heard a lot. And it's so interesting to hear these sort of episodes, anecdotes, what people have lived through, and what they've made of all of it. Rameshji, as Buffett says, mistakes of omission and commission. What hurts more? I mean, as Viraj said, you attend the call, you look at the price, and you can watch it every day, and you don't own it. You owned it, and you can't buy it anymore.
Omission. I mean, we've all done relatively well, but you have to say absolutely did we do well? We didn't. I mean, there's obviously more opportunity, and as someone said, there's so many stocks in your own backyard. Bajaj Finance was in my own backyard, in my wheelhouse, finance companies, and I missed it. How do I explain that to myself? You know, if I was a fund manager, I'd probably be fired. But I run my own money, so I still have a job. But it hurts tremendously. It hurts tremendously. Warren has taught us, Prashant, that you can't make a mistake in your own backyard. You can't make a mistake in your own circle of competence. In that, you better get it right, you know. And despite that, we've done well for ourselves. That's because growth has covered a multitude of sins. The Indian economy has been growing. We've all prospered along 89 onwards. When, as I often told you, when I came, the index was 800. Today, it's closer to 80,000. So we've prospered along with the country. I think we're some of the blessed generation of India that was born just after independence. He came to age in 89, 90, and we prospered along with the country.
Absolutely. Raamdeo, you heard so many youngsters sharing their experiences. Something resonates with you? I mean,
lots of them. No, particularly missing out on growth stocks. Like I remember I had HDFC Bank. That was probably only IPO where I had put 8-10 applications from my family. That was the only application, only because I had vision for HDFC Bank. And then it got listed, and it was so liquid at $40, means 200 crores about 800 crores market cap. You could buy any number of stock. I had about 5.5 lakhs shares. I'm talking about 96, 97.
Wow.
Then my net worth would have been about 8-10 crores.
Wow.
And then one of my employees' wife was working in HDFC. And she gave a right inside information that NetWest is walking out. NetWest was a collaborator as a bank. We said, now without NetWest, these guys, they don't know banking. We sold it. We sold it 52 rupees, 25 paisa. We didn't see the price below that.
Wow.
And after that, stock is up 1000x.
Wow.
So, these kind of mistakes happen, but yeah, you feel bad.
But at that point, that would have been the right decision? I mean, how? And with the benefit of hindsight,
you didn't even see the price go down, so obviously your judgment is wrong.
You could judgment is wrong, or maybe you could have corrected, but you were in a state of shock.
Right.
And then we started covering when it was already 20-30x from 2002 onwards.
Right.
Probably we overstayed also, like we bought so much of HDFC Bank. But what I'm saying is that this kind of mistakes, I mean, with so much of passion we had bought it. You imagine it must have been 15% or 12% of the allocation. Itna story, itna pustak, and then finally you just throw it because some useless information comes. So instead of checking with anybody, or so that like what happened to Astra. And Astral Poly, that P multiple expansion is like crazy. It went to literally 100 or something like that. So those are also not in your what you call realm of imagination. That like HDFC happened like a textbook. P multiple never went beyond 20, 22, 23, and it gave a consistent growth of 25, 30%, 30%. Yeah. So that was like a dream stock to have. Even today, while it is stalled, it is at all-time high market cap.
Absolutely. Samir has been listening patiently from Singapore. Samir, wish you would have been here, and would have added to the discussions. But you've been listening to everybody, what everybody's been sort of telling about their experiences. What strikes a chord with you? I'm sure you've made many of these mistakes. You began by saying that you've made all sorts of mistakes.
But I don't consider missing a multi-bagger as a mistake. These guys are beating themselves up too much. For example, if you say the guy's promoter was sitting or his office was nearby and you missed it, is the lesson that therefore next time the promoter who's next to you buy stock? The point is, if you look at pure numbers, and I have been a fund manager for like 30 odd years, not a prop investor. So my every NAV is black and white and not. And this NAV post a 2% management fee, if I take it for 28, 29 years, is up more than 500x. Now, there are not enough stocks that are up 500x, and I didn't even own maybe 90% of them. The point is that every 3-4 years, a lot of stocks go up. And then they disappear sometimes, or they underperform, or basically they become normal movers. But if you take a 3, 4, 5 year horizon, many stocks go up 3 times, 5 times. It is impossible to believe that you or the promoter or anybody knows that this stock is going up 500x, and therefore there is no mistake in that. For example, we just read recently, although it's been reported hundreds of times, that the Netflix founder went and tried to sell his company to Blockbuster for $50 million. The Netflix guy didn't know that his company is more than that. The Blockbuster guy, whose market cap that day was $6 billion, didn't know that this company is cheap or that his own company is going to zero. So all of the promoters don't know. So to be able to say, I didn't believe in the promoter.
I trusted you're going to come up with a philosophical take on the entire thing.
So I'm saying, therefore, don't call it a mistake. This is not a mistake because there are so many stocks doing well. Yeah. This is luck. Yeah. And luck should, so I'm saying don't beat yourselves up on the fact that you missed, because as many as you missed. So for example, if you say I missed a stock, it went up 50 times, most probably you bought some other stock which went up maybe 4 times. Yeah. So you missed 10 times, you not missed 50 times, you don't keep that money in the bank, cheer up. Yeah. We have discussed many mistakes, but don't make everything a mistake.
No. Only the show is called mistakes, otherwise everybody's in a pretty good mood. Safir, you ready with the next book? You got enough material here.
Well, let's have people absorb this and sort of become more learned and more educated about the process and become more long-term fixated than literally looking at the market every day. And if I've done that and I get the gratification and love of people, then of course I'll be inspired to do more.
Absolutely, and thank you for writing the book and sort of inspiring us to sort of put this program together. Thank you very much,
Thanks,
gentlemen.
Prashant.
Thank you very much, all of you,
Thanks,
for being
Reema.
with us here. Let me quickly sort of summarize the sort of different buckets of mistakes that we've heard outlined today. And I hope we have given you, the audience, a wide variety. It's like a buffet of mistakes to learn from and, more importantly, avoid. So here you go. Extrapolating too much from history, ignoring sort of global linkages, as Samir said, investing in a hype cycle. I think Raamdeo ji put that very clearly and nicely. Not paying too much attention to changing facts, numbers, data, straightforward corporate governance pitfalls. I think Punita alluded to that. Selling too early, I think, of course, as Samir said, don't beat yourself up, but it hurts. And of course, the big one, which I think what Ramesh Damani and others have highlighted over and over, not believing in the India story enough and staying invested through long periods without being too cynical about the overall scheme of things. I want to thank all our guests once again for being here. And of course, Reema as well for steering this discussion with me. And of course, everyone for candidly sharing all the experiences with us and our viewers as well. Samir, thank you very much for joining us. As I said, wish you would have been here, but wonderful sort of shares there. Thank you very much for staying with us here. Programming continues after a quick commercial break.